Hi everyone, my name is Evan and welcome to our brand new series, Beyond the Charts. Beyond the Charts is designed to give you insights into the TradeRisk's research process. We start by simply asking a question, and the question can be anything from, is there really such a thing as a Santa Claus rally, to something much more specific like buying a breakout after a very particular type of consolidation. No matter what the question is, we follow the same process each and every time that you might actually remember from middle school as the good old-fashioned scientific method. We start by simply observing the market, forming a hypothesis, and asking a question. Next, we gather our data, we write some code, and we conduct the experiment. Finally, we analyze those results and we compare them to what we thought might happen and draw some conclusions. So the goal of this series is three parts. The first is to simply ask questions and to test our assumptions about the market. Second is to learn how to write code. We're going to be looking at lots of code throughout the series and hopefully some new tools as well to answer those questions. Third is hopefully we get some good results or some meaningful conclusions from those experiments, and they'll actually impact the way we view the markets and invest or trade our own dollars. So all of this might not be for everyone. If looking at code makes your eyes glaze over, then we're going to leave some timestamps in the description of all these videos so you can jump around and jump to the end if you just want to see those conclusions, or in the middle if you're interested in learning how to program yourself. We're also going to have this available as a blog post so you can read through this instead of watching the video, and all of the code that we're going to go through in this series is going to be made public on our GitHub account for you to download and test out yourself. So hopefully this is interesting to you. We're super excited to get started with it. So without further, let's jump into today's experiment. Today we're here asking the question, is trading the golden cross a profitable trading strategy? And if it is it worth trading? Now, if you're not familiar with the golden cross, it's a fancy term for the intersection or the cross of two moving averages, the two most commonly cited moving averages in markets, which is the 50-day and the 200-day moving average. When the 50-day, which is the short-term moving average, crosses over the long-term moving average, the 200-day, you have a golden cross. And a lot of people will go as far as saying you're in a bull market if that happens. And when things go the other way, when the 50 crosses below the 200-day, you have what we call, or what is called, a death cross, when the 50-day moving average crosses below the 200-day, and a lot of people will call that a bear market. Now, there's strong opinions on both sides. It is very well cited when this happens. Some people believe in it and make decisions off of it, and other people dismiss it as being noise or not important. So what we're going to do is write the code today to actually run this test over historical market data and find out if it's actually meaningful, if it's worth trading, and if it's worth paying attention to. The tools we're going to use today are NinjaTrader and Microsoft Excel. That's all we're going to need, and we're going to jump into it right now. All right, here we go. We've got NinjaTrader 8 open. This is the latest and greatest of NinjaTrader 8 at the time of recording this, so June 2020. And we're basically looking at a default trading strategy right now. So this looks maybe a little intense already with lots of code in here, but this is basically the boilerplate starting template that NinjaTrader gives you when you unlock a strategy and start to code with it manually. Now, the only thing we've added so far is just some documentation in here, and we've given it a name and description, but basically from here on out, we're going to be writing the code to test our golden cross trading strategy on historical market data. Now, this won't be a total tutorial 101 of NinjaTrader. We're going to just kind of jump right in at this point. If you're starting out, you want more help just really getting started with the platform, leave a comment below. If I see enough interest here, I'll do a real kind of 101 tutorial for this platform. Now, Again, what you're seeing here are the default sort of settings for our strategy, and most of the work, most of the coding that we're going to do, and it's a pretty easy strategy today, but most of that is going to be contained in the OnBarUpdate method. So every single strategy will always have an OnBarUpdate method, and this is basically the driver of the strategy. So when you're running the strategy on historical market data, or if you're running a strategy live, what this method basically does is with each new bar of data that comes in, you'll start to execute some code, and the code that you execute is going to be contained within this method. So this is where, again, the driver of this strategy, and this is where we'll be spending most of our time. So basically, we're going to start in here right now. The only thing we have in here is this number 73, this if condition. And this basically says if the current bar is less than the bars required to trade, escape this method. So in this case, our bars required to trade, I guess I lied, I did update this already, is 200. And this basically just tells us we need at least 200 bars of data before we can even run the strategy. The reason for that is because we're using a 200 period simple moving average. So there needs to be 200 bars of data for that average to be calculated, and then we can actually start with the logic of the strategy. So hopefully you're following me so far. And again, this is a little bit dense, but hopefully as we do more and more tutorials, this will start to make more sense, because a lot of this is going to be basically the same thing with each new experiment that we run. There's always the same sort of ingredients and setup that we need. So we're going to continue on here. We're going to assume, we have enough bars of data. So the next thing that we're going to do here is that we're going to get started with our buy-sell rules. And what we're going to do is we're actually going to just write a new method called BuySellRules that will contain the rules to our strategy. So we could easily just write all of the code in the OnBarUpdate method. And if you have a very simple strategy or a very simple test that you're running, that's totally fine. But generally speaking, some good practice is to sort of modularize your code and write out the different parts of your strategy in different methods. That way it's just easier to debug and easier to sort of know what's going on. This strategy is pretty trivial, but we'll try and follow some good convention here. So the BuySellRules method is something we now need to define, and we can simply do it by this line here. It's not going to return anything. The only thing it's going to be doing is just monitoring if there's an actual trade or if there's an actual execution that should be happening. And the way it's going to do that is by using a built-in NinjaTrader method called crossAbove. And crossAbove takes two parameters, which are really arrays of data, and in this case the arrays of data are going to be moving averages. So you'll see that I just defined it as SMA fast and SMA slow. We'll need to define those in our strategy above, but basically what this will do is it will be monitoring these two arrays, so our fast moving average and our slow moving average, and as the name implies, crossAbove, it's going to be waiting for those to cross, and as soon as that cross happens, it's going to return true to us, and in which case, if that cross actually happens, if it's a true cross, then we want to enter our long position. We want to put our buy order into the market. So what we're going to do is we have to compute the number of shares, which we'll write another function for called ComputeShareSize, and then we just have to give this buy signal a name. So in our case, we're gonna call it a golden cross buy. And basically these two lines of code right here are all we need to get us into the market on a cross above. Now, one thing we need to do is define that SMA fast and SMA slow. So we're going to go up to the top of our strategy, and these are going to be SMA, so simple moving average objects, and we're going to have an SMA fast, and then we're going to have an SMA slow. So those two objects, we're gonna initialize them a little bit later, but that'll make this happy here for our cross above. Now we need to handle the other side, which is basically getting out of the market. And to do that, we're going to just do an else if, and we're going to use a cross below, which is, as its name implies, is basically the exact opposite of our original cross above. So if the SMA crosses below the SMA slow, we're not going to short anything in this experiment. We're going to just exit the long. And the way we do that is to use exit long, and all we have to do is reference the name that we gave our long order or execution, which is golden cross buy. So there we have it. That is that's in fact the 4 lines of code that you actually need for our buy and sell rules. Now we're obviously not done. We have a few other things to do. One of the things is to compute the share size, and the way we can do that is by creating another method. This case, it's going to return an integer. So this is the integer, which is the number of shares that we need to purchase, and it's going to be called ComputeShareSize. And it's a 1-line method here, which is, it's a little bit nuanced, but bear with me. We're going to have to define current balance in just a moment. But basically here, what we're doing is our current balance, which is just going to be our running account size, is going to be divided by the closing price of whatever this bar is. So that's the 0. That's the 0 that you see there, means the current bar. So we're going to divide our current balance by the closing price of today. And we are going to essentially be truncating it. We're going to be removing the decimal, even though fractional shares are getting sort of popular nowadays. We're going to be just chopping off and assuming that we can only purchase whole share sizes rounded down. And that will give us basically 100% invested portfolio each and every signal. It's going to take our total account balance and try and use all of that money to take our buy signal. And that's it. I mean, that'll compute the share size according to our, when it needs it from the buy-sell rules method. Now, we're not done yet because we do have a few more things that we need to code up here, and I am going to just sort of pause and kind of copy these in because they're a little more nuanced, and then I'll just explain them a little bit after the fact. All right, so I just copied in a few new methods here just to finalize our strategy, the CalculatePerformance method and the OutputPerformance method. So if we look at the CalculatePerformance method first, you can see this is basically just tracking. We defined and then are tracking 3 different variables: the unrealized P&L, the realized P&L, and then the current balance of our account equity. So we're just keeping track of that, every single bar that comes in, just to make sure, and for reporting purposes, how the strategy is actually performing. The second method we copied in here is the output performance. So basically, we're just printing out the dates and the current balance to our output screen, which we'll look at in just a moment when we run the strategy, just for, again, reporting and analytics purposes. So those two got filled in, added in some documentation, and included these 2 other methods in our OnBarUpdate method. So again, you can see we're now on every single bar that comes in. We're calculating performance, we're running our buy-sell rules, and then we're outputting the performance. One last thing we did was included this block of code in here, which is basically just plotting the simple moving averages. So the 50 and the 200 SMA, when we go to run this strategy with our strategy analyzer, we'll be able to see the actual moving averages get plotted And then we can visually just sort of identify, okay, the cross actually happened. Yes, we got filled, and everything, makes sense on terms of strategy logic. And then if we scroll up a little bit further, you can see I just defined some of those variables: the starting balance, the current balance, starting with $10,000 and letting it kind of rip, fully invested, just to see how well this strategy actually performs. So that's it. That is the total strategy. Again, this is this file, as you see it right here, is available to download, so you can start with the final version. You don't have to retype this all yourself if you want to duplicate this into your own workstation. So the next thing we're going to do now is to actually open up the strategy analyzer. And this is actually going to be where we run the code on our historical market data. Now, to take a moment and talk about data, data is super important, and it's super important to have quality data that is clean, that is accurate, and that actually represents either a total return index or the actual fills that you could get in the market. It is very important to not skimp on data. There's lots of free sources out there, but generally speaking, you get what you pay for. And if you're serious about really doing some research or potentially putting these types of findings or building your own strategies and trading them live, you absolutely want to invest in data. So we use Norgate for all of the stock market data that we have. They're basically the best you're going to find for the for the average retail investor. Unless you want to start paying mid five figures for data. Norgate's going to be sort of your best bang for your buck. We have a nice referral program with them, so if you're interested in supporting the show and if you're interested in picking up some of the data yourself and investing in it, we have a link down below. I would definitely check them out if this is a path that you want to go down to do some research and to test things out yourself. So with that said, all of Norgate's data is currently imported into NinjaTrader, and what we're going to do is we're going to run this. We're going to run our strategy on the Dow Jones. That is going to be our benchmark of choice. So the good old diamonds. We're using total return data, and we're going to use. A start date of let's go back to 2005, and we're going to end in December 31st, 2018. So we're going to run basically a little over 12 years, 13-year backtest here from 05 to 2018. And we're going to run our episode 001, which is the strategy that we just looked at. So we're going to click on the run button here, and we've got some results. We've got a total of 6 trades. We've got profit. Things look pretty good. We're going to pump the brakes before we look at this screen. I want to first just jump right into the chart to just visually kind of check in on this trading signals that we just generated. So if we just go all the way back to the very, very beginning, you can see here we're in the 2006 time frame right now, and we got our first buy signal here in November of 2005, in fact. So if we look at our chart, you can see the light blue line is the 50-period simple moving average. The yellow line is the 200 SMA, and you can see we got that crossover right in here, and the strategy ended up buying 134 shares at $74. So if we continue to follow this forward, you can see the blue line just continues to hold above the yellow line, so there's no reason to sell. We continue to just stay involved in the market, and as we keep scrolling to the right here, you can see that blue line's moving all over the place, but it's still holding above the yellow line until here, which is 2008, and we know what kind of year 2008 was, but the sell signal comes in from January 2008 at $93, and then just to dial it back again, we originally bought in 2005. So we were holding long diamonds for about 2 years, a little over 2 years, before the sell signal came in 2008, and this all checks out. If we look at the moving averages and we look how the strategy is performing, that looks correct. If we zoom forward here, we've got this big bear market that kind of develop throughout the next 2 years or so. And then we got our next buy signal, our next entry spot into the market in June of, this has to be 2009. Yes, it is. So June 2009, we get a golden cross here with the 50 period simple moving average crosses over the 200 period. The strategy buys, and again, if we just zoom forward here, you can see it stays in for about a year's worth of time before a little more whipsaw. So all of this looks pretty spot on. Of course, you would want to go through the actual trade history. You can see exactly the entry times, the exit times. You can see the percentage of profit, so on and so forth. So the question becomes now, we've looked at the actual chart to see that the strategy is behaving as we expect that it would. It does seem to be. So now we actually want to compare, did the strategy outperform just buy and hold? Is it worth trading? Now, this is where I get a little bit of, I have some gripes with NinjaTrader. It's a great platform for lots of things. For the actual result analysis, I tend to like to just do things myself. I've noticed some interesting behavior that I won't necessarily get into right now with NinjaTrader and analyzing results. So notice when we originally coded up our strategy, that last method of outputting performance is where we were printing out the performance to a log statement or to a log window for us to analyze. And we're actually going to use that right now. So if we run this strategy again and I pull up this window here, I've got the output of just the every single date that the strategy just ran, and then on the second window here I have our current account equity printing every single day. And so what I'm going to do is I'm going to take this information and I'm going to plug it into a Microsoft Excel template that I've built out to analyze the performance. So what I'll do is I'm going to take the I'm just going to select all and copy the dates that I printed out here, and I'm going to just put it right into this column, and that's fine. All right, so we're starting in 10/18/2005, and I'm going to go to our second window here. I'm going to select all, and I'm going to put this in our strategy equity column. All right, so now you can see we've got this strategy now populating. What we need at this point is a benchmark. And so there's lots of different benchmarks we can use. We're going to just use the diamonds as a total buy and hold, 100% diamonds buy and hold strategy as our benchmark. So I have a buy and hold strategy built out, and we're going to want to just double check here. So the starting date should be 10/18/05. So if you recall, remember that we started the strategy in January of 2005, but because we have a warm-up period of 200 days to get that moving average calculated, the first real buy signal, the strategy didn't necessarily activate until 10/18, which is 10 months in from January. So that makes a lot of sense here, and that's why when we run our benchmark, we want to start from 10/18/2005. We're going to run this strategy, and then we're going to copy from our output window again, and we're going to paste that right in here. So we now have the strategy and the benchmark. Got a couple of rows here just at the end to clean up. So let's just delete those to make sure that our performance tracks correctly. And now we're going to scroll all the way up here, and this is what we have. So what we're looking at is the benchmark, which is in orange, and our strategy, which is in blue. And so what you'll notice here is that if we just look at the historical equity curve of our strategy, you can see that it actually comes in pretty much exactly in line with buy and hold for this time period from approximately October 2005 to the end of 2018. Now notice a couple of important periods in here. Just notice how the strategy went completely flat in here throughout the bear market of 2007 and 8. The strategy, in fact, actually picked up a lot of edge here, a lot of alpha, maybe if you want to call it that, inside of this time period. So notice we had this big drawdown in the Dow Jones. Our strategy did not have that same experience, that same drawdown. It basically went sideways, picked itself back up here at the end of 2008, and then it proceeded to kind of push higher and track just like the Dow was doing. Now notice though, another interesting point in time here is 2014 to 15. All right, so notice that while the Dow Jones pretty much went sideways in this general area, notice that the timing strategy here, our golden cross strategy, started to draw down pretty significantly in 2014 to 2016 area. And if we scroll down to this second pane here, this is another chart of our drawdown. So basically, you can see the amount that the actual timing strategy and then the benchmark is drawing down from its all-time highs. So notice here in 2015 to 2016 how the golden cross strategy tends to underperform and starts to draw down as much as 20% here in this time period. So a couple of interesting time slices to certainly take note of. If we scroll over and just kind of take a look at some of the final output metrics. Now, if some of these metrics are foreign to you that we're going to look at, we've got a glossary that we wrote up on the TradeRisk website. We'll link it up below, and we'll share the link now appearing that you can look up the definitions to see how some of these things are calculated. But we're going to just run through now and look at this backtest. So we're looking at 13 years of data, and again, this is the strategy here. So this is the golden cross, and you can see we started with $10,000, we ended with $29,000 for 196% return. If we compare that to the benchmark, which started with $10,000 and ended with $30,000, you can see the benchmark ended up producing a 207% return. So they're very similar. The benchmark did outperform just by a little bit, but approximately pretty much the same thing. So that's actually a pretty good win for our strategy. If we look here at this next row, this is the compound annual growth rate. So CAGR for short, 8.6% for the strategy, 8.9% for the benchmark. So again, you can see very similar here. But this next one, which is max drawdown, is where the strategy really shines. So 20% was the drawdown. That was in that 2015 period versus a benchmark at 51% of a drawdown. So you can see now that this is where the benefit of a trend following strategy like the 5200 SMA cross actually adds value. It produced very similar buy and hold returns, but the drawdown was significantly lower. Another row here I want to pay attention to is Sharpe ratio, which is a way to measure sort of risk-adjusted returns, or the distribution of returns over your growth rate. And you can see 0.7 for our strategy, 0.48 for the benchmark. So again, you can see on a risk-adjusted basis, our strategy did pretty good here in terms of timing and producing returns and stepping aside during the bad times. A couple of other stats here. Time in market was approximately 80%. Correlation was 0.65. So you might be thinking to yourself, wow, this is actually pretty good. And it is for this time period, right? So notice I sort of cherry picked this time period intentionally to sort of kind of pull a fast one over everyone just to start. I intentionally chose 2006 to 2018 because this is a time period where a 5200 SMA cross actually did pretty well. You got all of the market return without nearly as much drawdown and volatility. And I'd say that's a pretty good win for the 5200 SMA cross. But here's the thing. What if we went back even further? And what if we actually took it to current times? So I've already gone ahead and did that. And if I go to the next slide here, we're looking at a slightly different story. And the different story is we're now looking at 20 years of data. We're going back to the 2000 on the dot, all the way to June of 2020. We basically took as much data as we could sort of get our hands on. We did almost a 21-year back test, and then we compared the strategy to the benchmark. And what you'll notice is again, the benchmark is the orange line and the strategy is the blue line. And you can see as we got to the very end of this test that the golden 250 cross did a lot worse than the benchmark. So the question is, well, even if it did worse, that might be fine as long as it stepped aside from a lot of the volatility. So let's go to our chart over here again. So now we're looking at almost a 21-year back test. We started with $10,000 for our strategy. We ended with 21.8. So we had 118% return. If we look at our benchmark that started with 10,000, it ended up having a $36,000 final value and a 263% return. So right off the bat, you can see there's a drastic difference in the end result here from the 50-200 SMA cross strategy to the benchmark. It lagged pretty dramatically over this much longer back test. Notice the CAGR, which is our compound annual growth rate, is now only 3.9% for the strategy, and it's 6.5% for the benchmark. So again, almost got cut in half from what it was before. So remember our first test that we ran here, actually it did get cut more than half. It was 8.6% compound annual growth rate. You can see down to 3.9. The benchmark at 6.5. And if we look at drawdown here, you can see that the drawdown for this strategy actually doubled. Its worst drawdown is now 39% instead of the 20% it was in our first period. So all around, we basically got returns cut in half and we got our drawdown that doubled. So you basically went in the wrong direction on both on both sides of the performance profile. Sharp ratio dropped down to 0.3, benchmark at 0.33, time in market reduced a little bit to 71%. So all around here, when we ran a 20-year back test on the Dow Jones for the Golden Cross, you can see returns just really did dramatically fall. You can see in the 2000 to 2003 period, this strategy did not perform well. You can see it basically just sold off with the market. It didn't step aside from that bear market. Now, of course, you could run this on the NASDAQ. You can see what the difference is there. But the bottom line is, with the market selling off with such wide movements here, it just continued to get whipsawed and it continued to kind of buy the top and then get sold off at the bottom. And it just rinsed and repeated that multiple times here and got chopped up in this period. It still did excellent during the 2007 to 2010 period, 2009 period. So that's good. And then if we look at the 2020 period, this really had a tough time with the latest sell-off in January or February, I guess, into March. It basically sold out at the complete low, or pretty much at the low of March. And then it, I don't think it, even at the time of recording this, has got back into the market yet. And we know that the market went on a total V-shape. So at the time of certainly recording this and running this test through the month of June, it basically hasn't got back into the market yet. It sold the bottom and it's just kind of sitting there. So if we take a step back and we think about the two questions that we set out to answer with this experiment, we asked, is trading the Golden 50-200 SMA profitable? And I think we can say yes. Yes, it is. In fact, if we looked at this 20-year backtest we ran on the Dow Jones, it did in fact turn a profit, 120% approximately, for a 3.9% CAGR. So yes, I think the answer is definitive on the first question. Now, the second question, is it worth trading? If I'm looking at the performance compared to a benchmark, I would say personally for myself, this isn't all that attractive of a strategy to trade. The drawdown isn't all that much better than trading just holding the benchmark outright. And the returns are significantly worse. Basically less than, almost half the benchmark with nearly as much drawdown. So for me, looking at this specific type of test, it's not all that interesting to trade. Now, a couple of other kind of final thoughts here is that this is not a complete comprehensive test. Of course, we would want to test this on other strategies. We would want to get more data. Test this on more timeframes and markets. We would want to get more data. We'd want to be maybe a little more rigorous with our buy-sell rules. So on and so forth. So for a real in-depth analysis here, there's plenty more that we could do. But for the simple test that we set out to build and test, I think we've got a good kind of picture here on how this strategy performs. It really does depend on the type of market environment you expect. So again, if we went to our first test here, when we looked from 2005 to 2018, this actually did pretty good. So if you think that the market environment going forward is going to look very similar to this type of environment, then the strategy gets better and better in terms of wanting to trade it. But if you're going to look holistically at a much broader view and you don't have a strong opinion of what the market environment is going to look like in the future, then you should probably consider that this might be a pretty good summation here of how the strategy might perform, and in which case probably something that you could find, you could find something better for your money. But again, everyone needs to figure that out for themselves. So hopefully this was informative. Hopefully this was helpful. We got to look at some code. We got to look at some new tools, and we got to answer a question here and get some actual data behind a 50, 200 period simple moving average. So now next time CNBC is touting it or Twitter is blowing up over the 50, 200 SMA cross, can easily point to this video and basically have some data behind the significance of those crosses. So that's it for me. Thanks so much as always for tuning in and watching our videos. Hopefully you enjoyed, and we'll see you in the next video update. Hey, it's Evan here again, and I'd love to know what you learned from this episode. Was there anything that stood out or surprised you? Leave a comment below and let me know your thoughts. Thanks again for tuning in and watching.